Well, I'd like to start by welcoming you all today to our webinar. I'm Sanjay Mistry. I'm head of our client relations team at Davies & Associates, and I should be moderating today's webinar. As a global immigration law firm, Davies & Associates has been successfully filing EB-5 petitions for well over a decade, and for clients from many different parts of the world. It's therefore great to see today that we have clients joining us from countries including India, the US, Vietnam, Hong Kong, Singapore, UK, Poland, and Bangladesh. We're therefore covering multiple time zones. So good morning, afternoon, evening to you all, and appreciate you taking the time to join us today. I hope you and your families are all keeping safe during this global pandemic. We decided to hold this webinar for two key focus areas relating to EB-5. The first is to give you all an update on the current programme and hopefully address some of your concerns relating to your own EB-5 petitions, particularly in light of some of the restrictions that Trump has placed recently in terms of travelling to the US. And secondly, from a tax planning perspective, sort of what are the key considerations which should be taken into account to maximize sort of tax efficiency. I should say that we appreciate that many of your questions are going to relate to your own specific circumstances and financial concerns. So it may not be appropriate in today's forum to address all of them as it's an open forum. So what we'd like to do is give you an overview of these key areas relating to tax advice and planning, with the aim of possibly scheduling private one-to-one consultations with either Abhijit and or Gary over the next couple of weeks to address your specific circumstances. So let me introduce our panelists for today. We have Gary. Hi, Gary. Gary Kaufman.
Hi, nice to be here.
Good to see you. Gary is our in-house US tax attorney based in New York. Gary has more than 25 years of experience in domestic and international strategic tax planning and provides US income and tax counsel advice for EB-5 applicants to promote tax efficiency. We're also pleased to welcome Abhijit Shah. Hi, Abhijit.
Hi Sanjay.
Abhijit is an associate director at Catalyst Advisors LLP. They are a boutique restructuring and advisory firm based in Mumbai and Pune. And our final panelist, who really needs no introduction, is Mark Davis. Hi, Mark.
Good morning.
For those of you who are not familiar with Mark, and I suspect that's probably none of you today, Mark is the chairman and the managing partner of Davies & Associates. So just to sort of recap, I'm in London right now. Gary and Mark are both in New York. And Abhijit, are you in Mumbai today or Pune?
Pune.
Pune, lovely. So yeah, very much a sort of a global webinar, really. So thank you all for taking time to participate. Before I hand you over to our panelists to sort of start the webinar, I should point out a couple of things. So at the bottom of your screens, you should see an icon marked as chat. So please use this during the webinar if you have any comments that you'd like to make during the panelists' presentations. But also, and importantly, there's a little icon marked Q&A. So we would welcome any questions that you may have for any of our panelists as they go through their presentations. And I'll pick up on particular questions to aim them at our relevant panelists. So if we're ready to go, perhaps Mark, we can start with you to perhaps give us an overview of sort of the EB-5 program currently. A lot of our clients who are on our call today are at various stages of the EB-5 sort of filing process. So, and I guess some of them would have concerns in terms of where they stand. So an overview would be particularly useful to kick off, Mark.
Sure.
I think.
So just looking at sort of the attendees, I think most of our clients on this call are from India, but I see a couple from South Africa. So, you know, we'll talk a lot to India, but if you're from South Africa or another country, you know, we have some local capabilities there. And if you would like to follow up in detail about local regulations and things that Abhijit will cover in a India context, we can do that with you separately on a complementary basis on a one-on-one with Gary. So, you know, let's just clear that. Especially South Africa, there are some sort of unique issues to discuss. With that said, let's talk about sort of where we are with EB-5, and I'll invite questions First thing is probably, you know, the presidential visa bans. Probably everybody on this call is aware that that does not apply to EB5. It does not apply to investment visas. So we have a number of clients who are, India's out of backlog right now. Vietnam and China are not. So we have clients who are in backlog who want to move to America. Some of them are using the E2 visa as well. E2 visa and EB5 are both immigration visas, and they are not subject to the presidential ban. The next thing that people are talking about is potential shutdown, or shutdown's the wrong word, furlough the USCIS because they've run out of budget. This is why you don't have to worry so much if you're an EB5 applicant. The reason is that the EB5 program, the IPO office, is separately funded. It's funded directly by the fees, the enormous fees, filing fees that you pay for your I-526 and I-829. So in the past, when the US government has shut down because they can't agree budget extensions, the EB5 program has remained open. Why? Because they don't need federal funding to run EB5. It's funded by directly by fees. So I haven't heard anything directly on this, but if USCIS do move ahead and furlough employees, I wouldn't expect them to see them furloughing EB5 employees because they're funded separately. So I think that's sort of another thing with EB5. Because most people are Indian, it's worthwhile mentioning that, you know, right now, EB5 for India is not in backlog. It's showing current. Don't see anybody from any of our clients from China or Vietnam online, so I won't talk about that. But USCIS, or the State Department, has made it clear that India probably will go back into backlog. And for those of you who don't know, what's going on is that the USCIS announced that they would stop processing I-526 petitions for countries where no visa is available. That effectively meant they stopped work on thousands and thousands of Chinese I-526 and some Vietnamese I-526 petitions and applications. That means that a lot of the Indian I-526s have started to speed up. That's good and bad news. It's good news because people are getting their I-526 approvals. It's bad news because the day when India goes back into visa backlog may be getting closer. Another little point, and this will be the topic, I think, of another webinar, lots and lots of people are asking about filing writs of mandamus. That's relevant. If your case, I-526, is taking a long time, then you can file a writ of mandamus, which is essentially a lawsuit against the US government. My view is that this is being used by lawyers who are desperately short of revenues right now to gouge clients for extra fees. It is something you can use if your case genuinely gets stuck. But we haven't filed one, I don't think, yet. Scott would be able to update on that because they've all been approved. In the last 3 or 4 months, we've had a flood of I-526 approvals. Other firms, same thing. There are a couple of firms who are saying, well, we've had I-526 approvals. It's because we've taken extra money from clients to file these lawsuits. So it may be appropriate in your circumstances, but for most people, I think it's just spending money for no reason. There are things you can do to move your case along, and we can talk about that. I think those are some sort of headlines on EB5, and I see a couple of questions, so I'll answer them. Where do I stand in relation to my investment in a particular project? Looking at the list online, a lot of people, I don't want to talk about specific projects because this will get too involved, but I'll make one exception. A lot of people on this call are in the Can-Am Spiral project, so I will talk about that. Can-Am Spiral, we're seeing lots of approvals in Can-Am Spiral coming through right now. So, so I think, you know, that will come through. So one of the things that we've always talked about that the immigration firms don't talk about is how safe is your money in a project. We can't make financial comments because we're not a financial advisor, we're a law firm, but there are legal issues associated with the safety of your money. So from a legal perspective, Spiral project is well structured in terms of protecting your capital. I think that some of the questions that you need to be, we are asking, and you need to be asking about that project have got to do with how much of the rest of the building is rented. We know that Pfizer have taken a substantial chunk of the building, which is great. Their lease is solid, and that's super. Can-Am are a very responsible regional center. They've really stood by clients in difficult times. All of that is very positive. But really, you want to be staying in touch of how much of that building is leased and at what rate. So if you want to, we can have a separate webinar about Spiral. I don't really want to get into it too much because a lot of the clients I see are not in Spiral and not even in Can-Am. So, you know, that's sort of some touch points because someone's asking particularly, but I think probably the better thing to do is to have a webinar about the Spiral project, because I think we have 30 plus clients, maybe 40 plus clients in Spiral. So we can have a webinar on Spiral. We can invite Jeff DeSico, the CEO of Can-Am. And whilst I am a workouts lawyer, I'll probably invite a real estate workouts lawyer as well, so we can get very, very granular on it. Let's see other questions.
Mark, there's a couple of questions relating to sort of timings at the moment. So one is from Nawaz, who's sort of suggesting, due to COVID, should we be expecting slower response rates from USCIS right now?
Well, I think covered this in that the IPO office, right, is separately funded by budgets. So in terms of the furlough of employees and different things, I think, you know, what we're seeing actually is a speed up in I-526 petitions right now for the reason I just explained. Unless you're from China or Vietnam, there's a speed up in I-526. And that's not just our firm. I talked to other firms. Other firms are seeing that too. Now, what happens if there's a COVID outbreak, right? Now, the IPO office is in Washington, D.C. They centralized all EB-5 processing. What happens if there's a major COVID outbreak in the IPO office for some reason, and, you know, 80% of the employees get it? Well, that's going to decimate. EB-5 processing. So I can't say that COVID won't negatively impact I-526 processing or I-829 processing, but at the current time, we're not seeing that. Next question, Sanjay.
I think the only other one is a similar one which relates to processing time, but I think you've covered this, but it was a client that had put a question in initially, which is, what is the processing time currently with EB-5 files? This client had put the EB-5 petition in October 2016, and it still hasn't been processed.
So again, if cases are really old, then that's a time. So let's talk about, if your case is old, the things that get done. 3 of these things we will do, will be covered by our firm. And Scott, who is muted but online, is responsible for making sure that in all our clients, these things are done. 1 is frequent correspondence and follow up with the IPO office as to the case inquiries. 2 is to contact a senator or congressman and have an inquiry. That will accomplish absolutely nothing at all. However, the reason you do it is because if you end up in court, the judge is going to say, what have you done to try and move this case along? So you want proof that you've contacted a senator. So Scott's team watch the files and make sure that we do that. The third thing is USCIS have an ombudsman program. And we really want to be reaching out once the case gets sort of a year and a half old, you want to be reaching out to the ombudsman. That is something you can do yourself, but it's something that Scott's team makes sure that we do. Reaching out to the USCIS ombudsman, and again, that will actually accomplish nothing with your case, except that if we end up in court, the judge is going to say, what have you done to move the case along? And proof that you've been to the ombudsman is sort of a key thing. So there's those 3 things that we need to do. 2 of them are just really a moot exercise that is preserved, if you like, documenting the record. And the other sort of note on the ombudsman program is that may get shut down because of budget cuts. I saw another question, which I thought I covered, about why might sort of the IPO office, I mean, we haven't had direct guidance on this, but why might the IPO office be immune to USCIS furlough? Well, I didn't say it will be immune. I said it's likely to be. And I think I explained that it's because it's the rest of USCIS is funded by the US federal government. So the US federal government gives it money to operate. The one area of USCIS that's different is the IPO office. So the IPO office is funded directly by the petition fees for I-526 and I-829. And that money goes directly to fund the IPO office. There's no general federal spend into that, which is why every time the US federal government has shut down, the IPO office has remained open and the rest of USCIS is closed. So, Kalyan, if you have more questions about that, please call me, and I'm happy to go through it with you again. But that's sort of generally the answer.
A point someone's raised is there is talk of America changing their immigration system, possibly to a points-based system.
Yeah, this is broad-scale immigration reform, and people talk about things all the time. As soon as we went into COVID, Trump came out and said he was going to reduce the EB-5 from 900 back down to 500, which had lots of people running around excited. Realistically, the chance of that happening is zero. That has to go through Congress. So the chance of large-scale immigration reform, which is what that would require, is very, very low. Very, very low in the current political environment. Can you say that it's never going to happen? No one can say that, because you don't know that there's not suddenly going to be like a big conference of the politicians tomorrow and they all reach a miracle agreement on immigration. But they've been trying to do that for the last decade and they've been able to do it. Trump's tried to push stuff through and he can't. As much as he might not like it, United States is not a dictatorship. It's a democracy. And so whilst Trump can impose regulations, he cannot change the law. So the type of thing you're talking about, Sanjay, requires large-scale legal reform, which we don't see any sort of political likelihood of in the near future.
Okay. Another question that's been posed, which is sort of on the same realms of what you've just covered, Mark. Is there a bill S386 proposed in Senate to block all green cards, including EB-5? And what are the chances of it getting passed? And what are the consequences on approved I-526s?
So this is something that's been kicking around for a while. What this is to do with the removal of country limits in different contexts, but including EB-5. So as everybody knows right now, every country is limited to 700 EB-5 based visas every year. This is why backlog and retrogression exist, because there's 10,000 visas overall program, and China sort of has had massive demand. So China's capped to 700 a year, so there's a huge backlog for China. That proposal is that they essentially remove the country caps. That helps India in the context of EB2 and EB3, and that's why like big Indian companies and the IT industry is in favor of this, because it generally helps India, because it helps the Indian IT industry with EB2 and EB3. It does not help EB-5, and it's a disaster for EB-5 unless you're from China. And the reason for that is because there's a huge backlog of Chinese visa applications. Right now, they're sort of going through at the rate of 700 a year. If they remove the country limits, then basically all EB-5 will go to China probably for the next 5 or 6 years, and nobody else will get a look in. So that's what this bill would do. I noticed on the chat groups, there was a lot of excitement, people saying, this is going to get passed, this is going to get passed. We are not a large enough law firm to employ lobbyists in Washington, DC, but some of the big regional centers we work with are. And one of the law firms I used to work with has a big lobbying department in DC. So I contacted all three. I spoke with Jeff DeSico at Can-Am about this. I've spoken with CMB about this. Both of those regional centers probably have the biggest lobbying capabilities in Washington, DC in the industry, as with IIUSA. What I'm hearing is that there's no chance of this getting passed. So contrary to what I've heard on the blogs, the politicos in Washington are saying that there's no chance of this getting through and impacting EB-5 in that way, and it won't impact EB-5. Is it impossible? Themselves, they don't know how their sort of neighbors from other states are going to vote on legislation, so nobody knows. Nobody knows. But all of the political lobbying, IIUSA, CMB, Can-Am, and they can't apply apply for statehood. So there's quite a serious lobbying capability. Nobody thinks this is going to get passed. Could it? Yeah, but the probability seems very low right now. And that's the answer to the question. If it does, if it passes as is, it's a disaster for India, because no one will get any, no one's going to get petitions for a lot of approval of green cards for a long time.
Mark, we're often asked sort of as a firm, sort of what is meant by a priority date when it comes to sort of adjudicating by USCIS, and could you perhaps just give a brief explanation as to what that is and what this might mean for Indians right now, which is where this question has been posed by?
Sure. So when you file your I-526 or any petition with USCIS, basically the date on which you filed that petition establishes a priority date. So with an I-526, there may be a day or literally a day or two's difference between USCIS receiving your I-526 and the priority date that they issue, but that really doesn't make a material difference. So it's essentially when they receive your I-526 and lodge it, they create a priority date. And it's just the date that the petition was filed. So then, if you look at the visa bulletin on the Department of State website each month, if your petition is waiting, you probably do, you will see there's two tables that pertain to this. And right now, for India, they both say C, which means current, which means that if your I-526 is approved, you can get a visa straight away. You don't need to wait. Or if you are in America, once your I-526 is approved, you can get an adjustment of status straight away. Don't need to wait. If India goes back into backlog, and no chance of, I'm seeing people from South Africa on the line, no chance of South Africa going into backlog. If the country goes into backlog, they will then publish a date there. And if your priority date is before that date, one, your I-526 can still get approved, right? So it doesn't really affect I-526, other than the sort of change we just discussed. Doesn't really affect I-526, but once your I-526 is approved, you'll have to wait. You'll have to wait until your priority date becomes current, meaning it's the same as the date in that online visa bulletin. You'll have to wait for that date to be able to get your visa. I think that answers the question. Sanjay, a lot of people want to hear about tax. So I'm happy to answer more questions about EB5. And if you have a question in general, please type it. But I don't want to keep everybody waiting for sort of Gary, Gary's enormous tax expertise, and for Abhijit. So perhaps we can switch to the tax part of this conversation and go through that. And then I'll be very, very happy at the end to answer questions. And I am seeing sort of a lot of questions about people's individual cases and about individual projects. And I think we can make some general comments about projects on here, but let's, especially with the big projects like Spiral, where we've got sort of 30, 40, even 50 clients in a project, why don't we have a separate webinar about that project, Sanjay? Does that make sense?
Yes, absolutely. And just a point that I made earlier, although we are getting some very specific questions for people's individual sort of cases and circumstances, our sort of aim today is to sort of follow up with all of you individually and have sort of private consultations. So we'll be able to explore a lot more detailed sort of your individual circumstances thereafter. But sure, let's move to Gary, shall we? Gary?
Hey, thank you. A central theme for today's webinar, which Abhijit and I are trying to impress upon you, is that why it is so important for the EB5 investor, whether the EB5 investor is still in the host country or home country, or whether the EB5 investor with his family is already in the United States, the importance to take a proactive approach as opposed to a reactive approach towards the whole EB5 process, culminating in receipt of the permanent green card. Because if, on the one hand, you were to take a reactive, passive approach and just let the time go by, and then you get the permanent green card awarded to you, your tax status from an income tax standpoint in the United States would be that of a resident, taxed on your worldwide income earned in any part of the world. And it would be subject to other harsh rules. On the other hand, if you were to take a proactive approach and doing this pre award a permanent green card period. You have this window of opportunity when you're still classified for United States income and transfer tax purposes as a non-resident. So you're not taxed on your worldwide income and you're not taxed on your worldwide holdings. Then by designing and implementing, working closely together and with Abhijit on an integrated basis, by designing and implementing these tax minimization, income and transfer tax strategies, we could save a lot of money in taxes for you. And that's the purpose of the exercise which we're trying to convey. So just very, very briefly, from a federal income tax standpoint, when you're a non-resident for tax purposes, it's a much more limited United States tax net as opposed to the aggressively enforced tax resident worldwide income concept. When you're a non-resident, the US tax exposure is limited exclusively to United States source investment income or United States business income. Now, this presents a huge opportunity for planning during this window of opportunity pre-green card award period, because we would work with you, we would focus on your personal and investment assets and on your business assets on a global setting. And we would see the various sources of income that you're earning and receiving during the year outside the United States. And if it is possible from a business and a financial standpoint for you to accelerate and to receive, whether it's investment income or business income, salary, bonuses, distributions from pension plans or whatever, if you could receive it during this window of opportunity non-resident period, you could avoid significant United States federal and state income tax on this income. So that's the first important point. Second important point, we're going to review with you your personal and investment assets and your business assets. And if you can identify assets that have significantly appreciated value relative to the time of acquisition, then if you were to wait in a passive, reactive manner until the green card is actually awarded to you and you're a resident, you're going to be hit with huge capital gains taxes, which would also include currency exchange gain when you convert the Indian currency into the US. However, if we were to sell or reorganize some of these highly appreciated assets, like if you're going to sell the Indian home anyway, might as well try to accelerate it during this window of opportunity period, then you can avoid tax. On the other hand, if you have investment assets, marketable securities that you want to hold on to throughout the EB-5 process, you could limit, nonetheless, when you ultimately sell, you could limit the US capital gains tax by doing certain planning transactions from a tax efficiency standpoint that would increase the cost basis of these assets without having to infuse additional capital, and that would reduce the ultimate capital gain on the sale. We would also work with you on focusing on the nature of your business interests. We have interests in startup companies in India or other parts of the world from a United States tax standpoint, keeping the focus ultimately on what would happen when you become a US tax resident. What can we do under the non-resident regimes to mitigate the ultimate significant tax cost if you didn't do this proactive tax planning? Finally, very briefly, focusing on the transfer tax. What do we mean by transfer tax? Unlike income tax, which focuses on the recipient of the income, transfer tax, gift tax, estate tax, generation skipping tax is an excise tax. It's a transactional tax on the owner transferor of the property. If he transfers the property lifetime, gift tax. If he transfers the property at death, estate tax. If he tries to make a direct transfer at death to a subsequent generation, like a grandfather to a grandchild, he skips a generation, skipping tax. And what's important is that unlike income tax, which is taxed on the gain, these transfer taxes are based on the full fair market value of the property on the date of the gift or on the date you pass away, and it's at 40%. And while there is an exemption, if you have significant holdings around the world which would greatly exceed that exemption amount, you could be hit with very significant transfer taxes. So just as we focused on the non-resident period from an income tax standpoint, the non-resident period for the gift tax and the estate tax is far more limited. And therefore, there's opportunity here for proactive planning during the window of opportunity period when you're still a non-resident. For example, what is the gift tax imposed on when you're a non-resident? It's just United States situs located tangible property, artwork or other tangible property, or United States real estate. That means that property outside the United States, or certain securities, etc., well, if you were to make an unconditional gift lifetime of those, you would not be subject to gift tax. And that's in estate planning. That could reduce transfer tax to you, because if you know in advance, I want to give this beneficiary this particular property. So, and if you're fully fine with relinquishing total control and dominion of that property while you're still alive, you could make a lifetime gift of that property which is located outside the United States, let's say foreign real estate or business holdings. And it would not only avoid gift tax, but it will take that property out of your estate. So when you ultimately pass away, and you're a resident and you're taxed on your worldwide holdings, you divested yourself of those holdings unconditionally through gift tax while you were still alive. So that's one thing we can talk about. Now, there are also traps for the unwary, right? And that is, even when you're a non-resident, many people don't realize this, but if you were to own United States real property, whether it's commercial or whether it's residential, and you were to pass away owning that property, notwithstanding that you're living full-time outside the country, not a US national, you would be hit with the 40% estate tax on the fair market value of that real property on the date of your death. And that exemption, a certain exemption amount, about 11 million that we talked about for resident, would not be available to you. So that's another planning opportunity during this window of opportunity until you become a resident. What can we do to avoid that risk? And finally, trust planning is extremely important during this window of opportunity period, because it's an opportunity not only to avoid gift tax on transfer of the property to the trust, not only to take those domestic or foreign assets that you contribute to the trust while you're a non-resident. If it's structured the proper way, you can avoid the 40% federal estate tax on your passing. You could also avoid on the surviving spouse's passing. And if certain trusts are set up, you can provide for succession planning on a tax-efficient basis that future generations, this property will go through your family, through future generations, avoiding transfer taxes. So once
Gary,
again, yes.
Can I just ask you a quick question? So, especially the clients we have who I would deem as ultra wealthy, all of them set up these trusts that you're talking about, but it's always a case that they're very anxious to do it before they get their sort of green card status, before they become residents. Is that right? Or you need to worry about the timing of this, or is that not relevant?
No, you're 100% correct. The timing is very, very important. You know, and the different types of trusts. Let's say you have excess cash in brokerage account, you'd set up a certain type of a trust while you're a non-resident, or you would set up a pre-immigration trust, you know, for other assets. It's very important that both the creation and the funding of these trusts are set up during the non-resident period.
So if I'm very wealthy, right, and I've got 2 or 3 kids, and maybe either the kids are getting a green card, or perhaps I'm getting a green card, or maybe we're both getting a green card. What you're saying is I could be throwing away tens or even hundreds of thousands of US dollars in completely unnecessary taxes by not setting up these trusts before either my kid or I get the green cards. Is that right?
No, that is exactly correct, because you're really focusing here on the creation and the funding. The funding takes advantage of the gift tax opportunities that are available to you through special strategies while you're a non-resident. If you waited, as Mark said, till your domicile, till you're a resident for estate tax purposes, the funding would be subject to the 40% gift tax. So that defeats the whole purpose. So that's why it's important to act with alacrity and on a proactive basis to create and fund these very special trusts while you're still a non-resident, to avoid the gift tax and then to plan for the estate tax.
Gary, I count myself as a very well-educated person. I have like a couple of graduate degrees at great universities. What the hell does alacrity mean?
No, it's just that with all reasonable speed. You know, you don't want to just do speed, you know, without forethought, but you want to have reasonable speed, and to work with Mark and to work with me and to work with Abhijit on a synthesized, integrated basis, so we can take advantage with reasonable speed during this window of opportunity.
Gary, we've had a question that's just come in, which is what are the tax implications of capital gain in case of selling real estate in India and buying property in the US? Is there any sort of tax exemptions if the same category property is sort of purchased, sort of, by which I mean resident to resident or commercial to commercial property?
Well, first of all, you would have to ascertain what's your tax status, at the time of the sale. If you're still a non-resident for income tax purposes in the United States, then the capital gain realized on the sale of the property in India would not be subject to the United States federal and state, and state income tax. If you're a resident of the United States, then you're taxed on your worldwide income, and so there's a tax treaty between the United States and India. So we would look at the capital gains article there too. But once again, we'd be working on an integrated basis together with Sanjay, because the objective when you have a cross-border transaction, let's say United States resident taxed on his worldwide income, selling property in India, there's not double taxation of that income. So that could be relieved under domestic law and under the treaty through a foreign tax credit, to offset the U.S. income tax by the Indian capital gains tax on that, on that income.
Sure. And Abhijit, are there any sort of Indian implications to kind of consider in that context?
You will have Indian income tax implications, Sanjay, depending upon the residential status. That's one. Second, you'll also have to figure a way to be able to take that money out of India to buy a property in US. So you're talking of the Indian tax law, US tax law, and both synchronizing and giving you exemption, and your capability or your permissibility to repatriate the proceeds of properties sold in India to buy another property in US. That you will have LRS restrictions if you are a resident under for the purposes of RBI, and if you end up becoming a non-resident for the purposes of Indian exchange control laws, then your limits are slightly different. So repatriability itself is a worry, and conceptually, or to answer it a very high level, I don't see that you will be able to claim any tax exemptions, at least in India, by selling a property in India and buying another property of same category and type in the United States.
I just wanted to add, from a U.S. standpoint, we would also look at the like-kind exchange rules. Just to see if you have foreign property and U.S. property, we just have to double check if those rules would apply here.
Thank you, Gary. Would it be useful now to move on to yourself, Abhijit, and then we can sort of field, because there's a lot of questions that are coming through which actually could cover sort of both aspects in terms of a view from yourself and Abhijit as well as Gary. So it might be worthwhile if you gave us an overview of sort of the work that you do with some of our clients, and then we can move to a more sort of fuller open Q&A session. Let me unmute.
Yes, Sanjay, thank you for passing it to me. I think from an India perspective, we have two major laws which we need to be mindful of when you're doing any kind of the so-called pre-immigration planning. One is the Indian tax laws, and the other is the Indian Exchange Control laws, which are commonly called as Foreign Exchange Management Act and the Reserve Bank of India directives. And in our experience, we have seen that there are a lot of conflicts between the Indian laws and what Gary would want you to do from a US perspective. Just to give you an example, from a US perspective, you need to fund your structure and create a trust before you become a US person, before you become a US resident. But from an Indian exchange control perspective, as long as you are a resident in India, you will not be able to transfer your Indian assets, Indian stocks, and Indian wealth into a US trust or a trust outside India. So that law is called as a resident is not permitted to transfer the assets, Indian assets, to a non-resident. In this case, this non-resident would be the trust outside India. In past, we've struggled to find a balance between the two requirements, and it's very, very complicated. The complications can differ depending upon the scale of the wealth and the size you're planning to structure. But that was a simple illustration which I wanted to cover on how the laws are conflicting. From an Indian perspective, we often advise our clients to plan their residential status and their overall Indian income streams and the wealth from a residential status perspective. Just to give you a perspective, let's say that you arrive in US and you claim your green card, and Gary can confirm this, that from the day you've claimed your green card, you are deemed as a resident of US for the tax purposes, because you made such declarations to the US authorities. While you have done that, the question to answer, or question which each individual needs to answer is, from that day itself, would you become a Indian non-resident as well, or you would still continue to be an Indian tax resident? Because the criteria under Indian laws and US laws are very different. If you happen to be a resident of both the countries, you need to find out where is the number of days stay, which is more than 183 days have been spent in which country, either in India or either in US, or either none of these two countries. And if an individual happens to be a resident of both the countries, in India because of number of days, and in US because the green card deems you to be a resident, then you need to see how your income will get offered to tax in both countries, in India as well as US. Unfortunately, both countries had the law as as a principle that for the residents, the worldwide income is taxable in both the countries, which means that if you are a resident of India, you have to offer whole of your Indian income to tax, and income earned outside India as well. And in the same year, if you are deemed as a resident of US because of claiming your green card, then you also need to offer your worldwide income to US taxes for the same financial year. There is something called as tiebreaker rule, which is envisaged in the India-US double tax treaty, and each individual needs to test this particular residency, as it applies to them. I would like to give one example. For an individual, let's say that you have you are a individual who has been a resident of India for a particular financial year, and you move out and claim your green card, and because of green card, you will be deemed as a resident of United States for tax purposes. And let's say that you have been holding a massive value in a listed company stock, just as your financial passive investment. If you end up selling this investment for any purpose after you've claimed your green card, you are liable to pay 10% tax, capital gain tax in India. But because you've also become US tax person, and perhaps you've not done what Gary would have advised you to do before claiming your green card, you will also pay capital gain tax in US at 20% rate. Now, this just means that the 10% taxable income just suffers 20% tax because you've not structured it at an appropriate time. This is where you need to be careful to plan well in advance before you claim your green card. The common solution we have seen in the Indian context is that if a spouse, one of the spouses is claiming green card, or one of the couple of children are claiming green card in one particular family, they would tend to transfer all their asset ownerships to the one who is not claiming the green card and would stay in India and just walk into US with what we call as an empty a balance sheet or without substantial assets when you move into US. This is a potential solution and a simplest solution, but in a context where the complexity of the wealth is not high. For example, you could have scenarios where the wealth could not be transferred, and if transferred, it may have implications in India. The second is a situation where whole of the family or one of the spouses is not comfortable in transferring the assets on the name of other spouse before moving out. There could be legal sensitive issues to keep in mind, and at the end, for with respect to your overall wealth, you are only procrastinating the larger structural issue of how your wealth would be structured when you have at the end become a US resident. When So this is a very limited high level perspective we would like you people to carry. I would also like to add what the exchange control restrictions could mean, and this is something very very complicated. We had a instance, I remember almost 9 years ago in India, when a large manufacturing company was held by a particular family in India, and that family, because of their personal and future needs, moved into US while they were holding the company shares. And this company was a closely held company for all the period they held it. The family decided to monetize and divest the whole of the closely held company to a large multinational group for a rough valuation of $400 odd million. And of course they paid taxes as would have been levied. But the bigger complication they faced was that the Reserve Bank of India told them, or brought it to their notice perhaps, that you cannot repatriate this $400 million in US where you are staying. And this is very critical. This is where we've seen most of the families struggling with this issue. The 400 million sale proceeds was ordered by RBI to be kept in India, even though the whole of the family and shareholders were staying in US for quite a long. This rule is called as a non-repatriability of assets investments in the Indian exchange control laws. And it says that if you acquired any asset in India while you were a resident for the exchange control laws, then any sale proceeds from those assets, whether those are, whether those assets are sold when you are in India or you move outside India, the sale proceeds must stay in India and cannot be taken outside India by the same person who acquired it originally, and he's now become a non-resident after claiming green card in US. What it does to the wealthy families is that you have your social presence in United States after claiming EB5, but your assets and your wealth is remaining in India, which and this exchange control restrictions are kind of a constraint in you making cash available to your place where you're staying and where you would like to pursue economic opportunities. So
Abhijit, I was going to say, so in that case, if I was to hold an investment in a closely held company and I'm planning to exit my equity, can I repatriate this money to the US after getting my green card and moving to the US?
No, you cannot, Sanjay. That's what exactly I explained entirely, that you cannot, because you acquired this closely held company when you were a resident in India. And because you did so, the sale proceeds must stay in India, even if you have become a non-resident subsequently. There is no time limit or there is no time cap prescribed that you can take it out after 5 years. You just cannot take it out. There is a mother exemption given to this, that once you have become a non-resident, you can only take out $1 million per financial year from India. And at times, like for example, the way I gave you about a $400 million corpus which the family earned, they were completely stuck, because in a 4-member family, taking 400 million out would take, maybe 25-30 years, and it still doesn't serve your purpose, because you want to deploy this sale proceed into the business opportunities which are becoming available to you in US. And the big question is, how do you do that from the exchange control perspective? If at all it means that the assets must stay in India, how do you address the concerns which Gary has, that your wealth should be completely structured in a trust or in a proper structure before you become a US person? So there is a conflict in these three aspects which can be solved, but clients need to be giving the attention which is required to address this issue. And of course, it has to be a derivative of what is at stake.
Can I just ask, so those trusts, we've had a question posed by an existing client. Do those trusts have to be created in the US, or is it acceptable to create the trusts in any other country?
So, it is very common question which we also face, Sanjay. But, if you are looking at trust being set up in a country like a BVI, Cayman Islands, Cyprus, or, those tax haven countries, you need to be extremely mindful of the fact that in multiple disclosures in India, you would keep reporting this trust. And of course, you would be required to report this trust completely in United States, and which Gary can vouch. The point is that India as well as US do not like these countries or these tax havens countries, and you would have significant amount of reporting pressures. Most of these tax haven countries have been identified as tax havens, or kind of blacklisted, so to say, by EU FATCA regimes and many countries. So you need to be careful while setting up the structure that it should be sustainable. The global laws will keep changing periodically, but remember that when you have structured it, this is only a one-time opportunity you have with you to structure your wealth before you've got your green card. In any situation, if you are to dismantle this sensitive jurisdiction trust and recreate a trust, you may have implications in US, you may have implications in India, etc. So it's important to consider the quality of location of the trust.
Okay. Thank you, Abhijit. We seem to have a couple of questions relating to sort of source of funds from India as well as LRS. So one of the questions we've had posed is that source of funds for Indians are difficult and tax planning on those source of funds is difficult. Are you able to provide some sort of real examples on source of funds? I think there's probably a FEMA issue here. Is there, Abhijit?
Yes, so it's a very, very, very tricky question, Sanjay. And I think in my experience, the biggest challenge which comes in source of funds is the fact that under Indian laws, it is considered that a whole family is one single unit. What we normally call as Hindu succession law and etc. So if there are numerous transactions on a daily basis between spouses or between father and son, and a particular individual and his uncles, all these transactions are considered very, very common because family is considered as one unit, even for tax and financial purposes. But this stands in a direct conflict with US, because you would be required to explain all those transactions which have happened within the families with evidences, explaining the purposes and rationales of why those transactions happened the way they did. And the source of fund explanation can just run into files and files and files. It's just unending. From a tax perspective too, usually the Indian tax returns do not give out significant information which would help USCIS to consider it from the US source of wealth, because you would have inconsistencies in what is being reported as income for the purpose of tax return. Your bank statements would talk something different, and you would have your financial statements of yourself and your entities which may perhaps not reconcile with your tax return. So that is something which is very, very critical. We have seen that whenever you're doing source of fund, it takes significant amount of time to be able to produce documentation and evidences which would satisfy USCIS, because the ultimate objective of doing the whole exercise is to ensure that USCIS is satisfied with your source of fund.
Sure. On a sort of similar question, with the change in the program sort of in November last year, where the investment level for EB5 rose to 900,000 sort of US dollars, how is it best to structure the remittance under LRS for sort of funding into an escrow account to move that money out of India?
Yes, so it's tricky, Sanjay. It's very, very tricky. Um, you know, you have to also keep in mind that with effect from 1st October 2020, you have a new rule which is kicking in which says that there would be tax deducted at source by the AD bank while allowing you a LRS remittance from Indian account. Um, uh, the purpose of doing this, as we understand from the government, is that you know, they don't want to tax your LRS transactions. This is a incorrect notion. This is not a tax levied on your LRS. Whatever is the tax withheld on your remittance is available to you as a credit in your tax return against your income. And if at all you have excess tax being paid because of this particular deduction, you would subsequently be able to claim the refund from your tax return. The key is that they want to they want to be able to trace your LRS transactions, that you know, you've taken this particular amount out of India. This transaction would now suddenly start appearing in your tax returns, and you would perhaps be asked justification from the income tax authorities when your tax returns come for scrutiny or audits. From a structuring perspective, Sanjay, which the question you asked, you perhaps have to have you know, your requirement of LRS being broken down within family members, or you know, within family members as well as financial years. For instance, you know, let's say you're able to use your $250,000 LRS limit in March 2020, and balance you are using in, let's say, April or May 2020, which breaks the financial year and gives you a you know, double limit being available with you. But it needs a lot of planning. One hurdle which we have faced is that whenever you remit you know, funds outside India for multiple family members in one family, let's say you, what it is, it's usually referred to as accumulation of LRS limit of the whole family as one. And if you do that, you have to deal with certain clauses in the Foreign Exchange Management Act, which may require you to hold the asset in the joint ownership for all family members, or structured in a escrow kind of a arrangement where you know, you legally legitimately get a right to deploy it on one particular name. So it's tricky. I would advise my clients not to even seek a off-the-shelf solution for structuring your LRS remittances. Consult your you know, RBI or FEMA advisors. Get 100% comfort before you make the remittance for this purpose.
Thank you, Abhijit. I have a question here for possibly both yourself, Gary, Abhijit, and maybe also Mark, really. What are the best mechanisms of investing in India when you become a US resident? What are the best investments in the US besides stocks? That's obviously quite an open-ended question, but if we had an answer to that, we'd all be putting our money there. But are you able to give any advice on the first part of that question?
Let me step in here, and then sort of really it'll be questions to Gary. So one of the things that investing in America that foreigners really are amazed by when they realize what it means is a triple net lease. So in India, right, properties had real difficulties, I would say, in the last, you know, correct me if I'm wrong, Abhijit, sort of in the last 5-10 years, people have not been happy with the performance of their portfolios in India. And there are inherent risks baked into real estate investment in India. From a legal non-tax perspective, a lot of the products in America don't have some of those same risks. This is about taxes, people are asking. So, or perhaps they're not. And we can have a separate webinar about this more generally with a financial advisor, as well as, you know, I spent a lot of my career counseling major institutional investors in distressed assets. So, you know, we can talk about this, but I think it would be helpful if Gary and Abhijit talk to some structural differences in America that can be attractive. And the one that comes to mind, bluntly, is coming up recently in Vietnam and also in India, is when you really explain to clients what if you're investing in something, a triple net leases, and how that can be very efficient. That might be a good example, and perhaps you two have some comments. Gary?
Well, in general, if you're a foreigner and you're investing in U.S. real estate, being residential or commercial, you have to deal with the United States Foreign Investors Real Property Tax Act. The acronym is FIRPTA. And that's extremely important. You know, if there's rental income, you know, that's being derived. A lot of non-residents don't realize that if they don't make special beneficial tax elections in the first year that the rental income is being derived from the property, they're going to be hit with a 30% withholding tax on the gross rental revenue. So there is definitely a tax planning with respect to that. Also, when the property is ultimately sold, there's going to be significant withholding based on the sales proceeds at the closing. So, so there are structures that are set up to, you know, pre-acquisition to take care of the, you know, the rental income and avoidance of the withholding tax, and also, you know, to take care of the ultimate sale to avoid FIRPTA withholding at the closing. And what's most important, which was alluded to before, was that if the owner of the property were to pass away, you know, prior to receipt of the green card, while his status is still that of a non-resident, that estate would be hit with a 40% estate tax on the full fair market value of the property at the time of the passing without any relief. The only relief is a $60,000 exemption. Unlike if you're domiciled, if you're a U.S. tax resident, while it's true that your worldwide holdings, you know, but you have that least, that 11 million exemption, that's not available to you. Now, some countries have estate and gift tax treaties with the United States, such as Australia and throughout Europe, so you can look for mitigation of the 40% estate tax via the treaty. But if there's no estate and gift tax treaties, such as with India, you know, and the United States, you're really, the estate could be hit with this confiscatory tax. That's why it's extremely important, as we said, you know, pre-acquisition to set up the right structure, you know, from the United States income and estate tax standpoint, you know, coordinating, you know, with the Indian tax rules, you know, to try to mitigate and to try to avoid these unnecessary tax risks.
And one thing I would say, right, about investment in America, from a legal perspective, is it's the same thing when people are investing in EB5 projects. You have to be very careful. You have to realize you're investing in another country, and you have to look at it very quickly. For some reason, I don't know why, Indian investors think that because it's a hotel that's run by a relative or is recommended to them, it means it's solid. Hotels, as an asset class example, have inherent risks in them that other asset classes don't have. And, you know, so be mindful of that. But that being said, because of COVID, I would say that there are some, you know, I can't give financial advice, but there are some bargains right now in America, if you're willing to sort of weather the storm of it. And we can have a separate call about that. And there really are some good, you know, I just watch sort of the investors I've known over my career, the professional investors who make a ton of money. And some of them are starting to snap up very cheap assets right now. So we can have, as I said, a separate call about that. But there are some opportunities in America right now if you're willing to weather the storm. You know, what I hear these people say is, we don't know when things are going to pick up. And, you know, things could get rougher before they get better. But you know, there are some opportunities, and I think discussion of the particular asset classes and assets is beyond the scope of this webinar, but we could certainly have a webinar focused on that and talk about that and have some proper advice. Did you have some tax ideas on this, Abhijit?
Yeah, I mean, not really ideas, but it's, I just wanted to add to what Gary was mentioning, that India taxability of such a property acquisition would be very simple. If this property qualifies to be held as long-term asset, you will pay 23% tax in India, and perhaps you may be able to take a credit in US for that. And if it is not qualifying as a long-term capital asset, you will pay tax as high as 43% in India. And you may then be able to claim the credit of that tax in US, which means that, you know, you are paying substantially excess. The point here is very critical to see that there are exchange control restrictions for foreign in foreign citizens to hold property in India, you need a prior RBI approval. So if you've gone to US, you've claimed your green card, and then you've gone to claim your passport, and then you are acquiring property in India, then perhaps you need a prior approval from a Reserve Bank of India, which is not very easy. And if you are simplicity or NRI, then you still have to follow the restrictions under foreign exchange control laws before you take the property. And as a thumb rule, you're not allowed to hold any agricultural land in India after you become an NRI or a foreign citizen, either of them.
One extra thing that's worth remembering is some of the investments you can make in America as a bonus can have positive immigration consequences. So as I mentioned, the E2 visa is not subject to the presidential ban. If you buy a business in America of any decent size, you're likely to instantly qualify for an E2 visa. So if you're either not sort of on the EB5 program, or if you're stuck in the EB5 program, by investing in a business in America, you could make yourself eligible to move to the United States, subject to the consulate being open to actually issue a visa. Subject to that, you could qualify yourself instantly to move to America. You can also structure that so that family members or other people you know perhaps can invest in your business, and they can obtain US immigration benefits from doing that. That wasn't the question, but it's worthwhile remembering that there are lots of good opportunities right now to invest in different asset classes. I think if you're willing to weather the storm, we can talk about that. When you do that, be very mindful of the tax consequences. Think that through, which is what Gary and Abhijit have just talked to. Also be aware, as a bonus, either you or your family or people you know could have an immigration benefit from the investment that you make, depending what it is. That's pretty much.
I just wanted to supplement what Mark and Abhijit mentioned about classes. If you're a United States resident, once, for example, you get that green card, you have to be very careful about the type of startup companies or corporate investments that you have in India or any other country. Because once you become a tax resident, it's not just that you're taxed on your worldwide income, but there is onerous tax reporting for US investments abroad or financial assets abroad. And there are different foreign corporate tax regimes under the United States tax law, depending on the percentage ownership with respect to that foreign corporation. Is it an active business, an operating business? Is it a holding company? It's just passive. So that is something you'd have to be careful and get tax advice from Abhijit and I prior, to making that investment once you become a US tax resident. Also, you should be very wary about investing in India or foreign mutual funds, because that's a special class of asset tax rule, not only from a reporting standpoint, but if you're not careful, there could be draconian, very harsh US tax results on partial redemptions or complete ultimate sale of that mutual fund or receipt of dividends from that mutual fund. So there's definitely tax planning for that. And the final point is that from a tax planning standpoint in the United States, there are different tax strategies and planning that can be very beneficial for the family once they're in the United States, with respect to life insurance. But again, that would be, we would have to start the process when you're a non-resident.
So Gary, what I just heard you say is, if someone's doing EB5 or they're going to America, even as a non-immigrant, actually, it's not just the sort of mechanics of the EB5. They need to be, if they're of meaningful wealth, you need to be talking about your global investment portfolio, right, and how to restructure it, right, before you set foot in America.
Mark is 100% correct, and that's why Abhijit and I, we always ask at the outset for an inventory, a detailed inventory of your non-US assets, besides the US assets, but because we're going to have to study that from an income tax standpoint and from a transfer tax standpoint, always looking ahead. What's going to happen if you're passive and reactive and you don't do any planning? All of a sudden, worldwide income, these draconian tax regimes, tax reporting. So now is the time to look at these classes of assets, restructure, reorganize, simplify from an income and estate tax standpoint?
I think, you know, a couple of cases just is worth mentioning, sort of come to mind of clients we've had who initially from India have said, oh, I don't need to do the tax plan. Then they get their I-526 approvals and they start looking at it. Well, if you're at the I-526 approval stage and then you realize that you need to do tax restructuring, you may not have time left for statutory reasons or for other reasons. You may not have time left. However, in that scenario, from an immigration perspective, in 2 cases I can remember, we've stepped in and we've slowed down the process. And we've delayed the process of getting a green card to a different tax year because that allows for the tax planning to take place. So the lessons of that is 1, do the tax planning early so that you don't get stuck like that. But 2, if you haven't yet applied for or used the immigrant visa, there are things we can do to delay the process that allow you to tax structure and to move your sort of immigration to a different tax year. So, you know, it's never too late. Until you set foot in America. So that was point 1 I wanted to mention. And then point 2, perhaps, you know, Abhijit can comment on, is if you enter America, a lot of people think, well, I'm entering in a non-immigrant capacity. I'm entering in an L1 visa or an E2 visa or something else. I'm not an immigrant, so I don't have to worry about that. But long term, right, they may change into a green card holder in the future. So I would just like to hear Gary and Abhijit's comment about the idea that I don't have to worry about this so much if I'm entering in a non-immigrant capacity and might change to a green card in the future.
You know, you always want to be proactive. And, you know, if the ultimate goal is receipt of the green card, then you have that window of opportunity period from an income and a transfer tax standpoint. That's why it's so important to have open communication. You know, the client has to really disclose to Abhijit and to myself and to Mark and his team, what are your short-term objectives, personal and commercial, and what are your long-term objectives, you know, personal and commercial. And if the green card is part of that ultimately, or changing to the immigrant visa ultimately, it's important to factor that into the planning as it's being done.
Right. And Mark, when you're entering in US with a non-immigrant visa, if you have the doubt in your mind that you may go back to India, you may want to ensure that your structure is such that it is flexible if you choose to stay in US or if you move out, because exit from US from a tax perspective is also extremely complicated. And just one more point, which is a supplement to your first point, Mark, is that any client should budget at least 6 months, and from 6 months to 18 months for the comprehensive tax planning, or let's call it a pre-immigration planning, depending upon the complexity of facts and the wealth.
So Abhijit, I know that you've become India's leading expert on the double taxation agreement between India and Grenada. So we see increasingly some of our EB5 clients and other clients making a Grenadian citizenship first as they move to America, or perhaps doing Grenadian citizenship and not even ever moving to America. Right. Can you just, like, this is about EB5, but can you just like explain why, from a tax perspective, someone might want to do Grenada? Because I think a lot of people think of that, well, I can get an E2 visa, or I can move to America faster. But I think that you've figured out some tax advantages to that, right?
Yeah, so the tax advantage is coming from the fact that Grenada is a country which is not considered an adverse tax haven. It's considered a qualitative jurisdiction, and under the Grenadian laws, the resident of Grenada is taxable only on the income earned in Grenada. So even if you are a Grenadian citizen, Grenadian resident, and you are holding assets, or let's say stocks of a closely held company outside Grenada, any gain arising on those assets is not taxable in Grenada. If you are able to structure structure your wealth appropriately, you may be able to achieve a result as follows. One, that your wealth may get structured or held through multiple boxes under Grenada, which means that it's not a US driven wealth and it's not an India driven wealth. That is the first point. And if you are able to structure your Grenadian holdings in a way that there, there could be substantial tax savings on the divestments of closely held or a public company stocks if you are holding. So let's say you're talking of an entrepreneur who is already holding a closely held company with, let's say, $100 million top line, and he is able to structure it through Grenada appropriately. Then on the divestment, which he may have in his mind sooner or later, he may be able to optimize the entire taxes on such sale. You could achieve a result where there is no tax being payable in India or in US, even if you are a US tax resident, because the wealth would get taxed under Grenadian entities, which would be Grenadian tax residents. So it's complex, but that's the ultimate objective you may want to look at. So Sanjay, do you have any other questions?
Yes, I'm just going through our list here. So this is probably aimed at yourself, actually. Well, it is, Abhijit. So what if someone was to receive, as part of an estate in India, through will or succession, will they be able to repatriate sort of the funds to the US, and will there be any tax implications to that?
No, so it is extremely unfortunate that I had to answer this, but the exchange control restrictions in India prevent you from repatriating the wealth, even if you have received that wealth through a will or inheritance. Let's say that your client is moved to US along with his spouse and children, and claimed, all four of them have claimed the EB-5, and this particular client receives let's say substantial chunk of wealth from his father in India through his will. He still needs to keep the whole wealth in India. And if he wishes to take this wealth out or repatriate the proceeds out of India, he needs to prove to the Reserve Bank of India that if this wealth is not being repatriated, he will suffer something called as hardship by not being able to take the wealth. And if it is already a substantial wealth and this particular individual is well-to-do, you will not be able to substantiate the hardship to the satisfaction of Reserve Bank of India, which effectively means that while you have a window to seek approval from Reserve Bank, but it's very unlikely that the approval would flow in. We have experimented the approval in 3 or 4 cases, and we have succeeded in 2 or 3 of them, and we're still struggling since almost 2 years with one of them.
Thank you.
It's been 2 years that we've not received the approval from Reserve Bank.
What about EB-5 funds, if they're received as a gift? What's the sort of tax implication of those, sort of either in the home country or the redemption?
So, if let's say that you received the EB-5 funds from your relatives when you were resident in India and you invested in a project in US, and by the time the redemption is happening, you have already become a US tax resident. In that situation, you would only pay tax in US on that redemption, and you will not have any tax implications in India, because the asset is outside India and you have already become a non-resident. And this is not an India sourced income. So you are a non-resident, the asset is outside India. There is no source connection with India and no tax in India when you seek redemption. The condition is that you should be non-resident for Indian tax purposes in the year you get the redemption.
Okay.
I just wanted to add to that from a US tax standpoint, that in a situation when there's a gift, the funding of the RBC investment comes from a relative or a friend who lives full-time in India, is domiciled in India. So what a lot of people don't realize is that the United States gift tax law extends to non-US nationals, non-US residents who make a transfer of property if the transfer of property could be deemed to be a transfer of US situs assets. So in a case like this, we would have to carefully structure the movement of the funds from India to the US resident in a way that is carefully documented, and we can prove that it's really a foreign situs asset, and thus it's not subject to the federal gift tax on the transfer. Also, there's a reporting responsibility on the recipient. If the recipient is a US resident, for tax purposes, then he would have to file a certain form reporting all gifts received that calendar year from the person that exceed 100,000 US dollars to avoid penalties for non-compliance.
Gary, so a couple of follow-up questions. Perhaps you could clarify, one, in the United States, who generally pays the tax? The person giving the money or the person receiving the money? Two, let's suppose that I have a sister in America and I did EB-5 and my sister gifted me the money, right? My sister is a green card holder or a passport holder. Nobody told me about any of this tax stuff. So I was gifted assets in America by my sister. It's in an EB-5 sort of account right now. None of these forms were filed because I didn't know about it. Can I file the form? What's the consequences if I don't? Like, just very briefly, like if you could answer those two questions, I think it might be helpful.
Well, in law school, Mark and I and Abhijit, one of the things that the professors always stress is to preface the question with, for the purpose of. So in answer to Mark's question, for the purpose of income tax, then the focus is on the recipient of the income. On the other hand, for the purpose of transfer taxes, gift tax and estate tax, those are transactional taxes. So the focus is on the transferor, the owner of the property who's making the gift.
So I think what you're saying is, right, if I'm given money in India and I'm not US tax resident when that happens, there can't be any income tax consequences, even if there otherwise are, because I'm not a resident US taxpayer. So Abhijit's shaking his head. I'm just trying to get clarity on this so that I understand.
Yeah, so there's no India tax, Mark. There's no India tax on that.
Right.
No
so that's the income tax. So the other side of it, Gary, of that transaction, my sister's
Mark,
in America, right?
Sorry to pause you. Look at this complexity. You are saying that to be able to do this pre-immigration planning, you need to do some inter-family gifts. But those gifts from you should be done into a kind of a succession planning and a tax-proof structure prior to you becoming your US person. And if you do that, then you have to look at the India side, which says that as long as you're a resident in India, you cannot transfer your wealth or your shares to any person outside India, and a trust outside India is considered any person outside India. So a balance between the two and a way out between the two is critical.
Gotcha. So going back to Gary, my sister's resident in the US. She gave me the money. I'm not a US tax resident. Sort of what is the implication of her? And now let's suppose this happened 2 years ago. No forms were filed. What should we do?
Okay. In this particular instance, as we said, we're talking about the gift tax, right? 40% gift tax on the amount of the transfer. We look at the transferor. The transferor, the owner of the property who's making the gift, is the sister. Now here, she is a US tax resident, not a non-resident, right? So therefore, she'll get the benefit of that unified credit, that there's an integration of gift and estate for credit purposes, meaning that a person throughout his lifetime or her lifetime can make, under current law, a total of 11.5 million in transfers of property unconditionally, either at lifetime or when they pass away by will or by inheritance, free of gift and estate tax. So what your sister, so in other words, assuming she hasn't made total gifts to date, lifetimes in excess of 11 million, that transfer to you will be exempt from federal gift tax because it's covered by the unified credit. Now, she may have to file a gift tax return, not just reporting that gift to you. There will be no gift tax consequences to her. And since it's a gift, there are no income tax consequences to you on receipt of that.
Gary, if she didn't do that 2 years ago, would your advice be she does it now? And if she does it now, is there a penalty for late filing?
Well, I believe, and I could double check this, just in general, part of my practice is to represent United States of foreign people who are delinquent with respect to tax reporting. Now, as we said, there are onerous U.S. tax penalties, $10,000 for failure to file this form per year. And it could go back for 3 years or 6 years, you know, in certain instances. So there are amnesty programs to, if you could show that it was done in good faith, reasonable cause, et cetera, so penalties would be eliminated. I believe there's a special gift tax rule that if this gift tax return was not filed, but no gift tax would be due in any event because it's covered by her $11 million unified credit, then no penalties would apply. So in that case, and I could double check this for you, it might not even be necessary for her to file, you know, that form currently to make up for the delinquency, because under that rule, there was nothing due anyway, tax-wise, because of the credit.
So I can breathe a sigh of relief, basically.
Definitely.
Karen, is what you're saying. Yeah, thank you.
We have a question on exemption. So can an EB5 investor and or spouse on a green card claim $11 million exemption limit for estate tax and inheritance tax?
Well, once again, they're raising a very good question for other reasons too. The definition of residence for United States tax purposes, for transfer tax purposes, is different than the definition or the start of residence for income tax purposes. For income tax purposes, receipt of a permanent green card in and of itself creates tax residence. Now, if people are EB5 applicants and they're already present in the United States with their families, if they're not careful, and this is another planning opportunity, you could commence U.S. tax residence in advance of the green card just based on significant presence in the United States in a particular year and the 2 preceding years under what we call the substantial presence test. So we would have to monitor in advance, working with you and control your presence under the substantial presence test under this 3-year period to, as Mark has said before, to keep it under the radar, so therefore it doesn't trigger U.S. tax residence.
So Gary, this is what I was asking you earlier about non-immigrant visas. Because if somebody goes to America on a non-immigrant visa, and then they transfer to a green card later, I've just heard a lot of clients say, I don't have to worry about any of this because I'm only a non-immigrant. Now you're talking about establishing residency before people get a green card. So, you know, if you can throw a comment on that and the danger of that thinking, that would be helpful, I think.
Yeah, see, a lot of people don't realize this, but there's several independent predicates factually that can create a U.S. tax resident. That's why we always say, Abhijit and I, in tax planning, it's not just the planning opportunities with alacrity, but it's also avoidance of traps for the unwary. So here, person comes in, as Mark said, I'm non-immigrant. I'm not getting a green card. I'm not a U.S. citizen, so I don't have to worry about worldwide income. But if they're not careful and they actually have significant presence in the United States in a particular year, more than 183 days, or under certain average weighting formulas for the substantial presence test, looking at the 3 years in an aggregate, if they come out in excess of 183 days, then in that tax year, they're going to be a U.S. tax resident. Now, all the implications that flow from U.S. tax residents would take effect with that year. Worldwide income, filing the resident income tax return, classification of foreign investments, investments in foreign company, and if they miss it, then they're delinquent with respect to tax reporting. They could blow. You have to make certain favorable elections, as we mentioned before, when you're a resident, and you have to characterize for U.S. tax purposes your foreign startups. And if you didn't make certain favorable elections in the initial year of your U.S. tax residency, then you're stuck with the adverse tax treatment. So it's very important, as Mark says, on the non-immigrant, to realize there's this independent predicate to create U.S. tax residency and what can be done. Just like with the green card, Mark said you could delay the award. The same thing to calibrate your presence in the United States pre-green card to avoid triggering tax residency.
Okay, another very common mistake I see, and often it's because people just don't know about it. Can you just give us a comment on, when I become a US tax resident, a green card holder and a citizen, perhaps, what is my responsibility to report my foreign accounts? Because I have a lot of clients who have never heard of this, And they're
Yeah.
like, you're telling me a lie. I don't have to report any of this. Can you tell me how that works and what an Abhijit chip into? I think it's worth reminding people of this. Can you explain that and how it works and what you have to do and what the penalties are if you don't do it?
Well, this is a very important point because it's not just, as we said before, U.S. tax residency. The implications are not just taxation on worldwide income. All of a sudden, there's vast tax reporting, and this is enforced with penalties. For example, if you have foreign bank accounts located offshore, or if you have foreign mutual funds, or accounts with foreign financial institutions, or if you have let's say, foreign life insurance with cash surrender value, and there's a whole slew of other, type of offshore financial assets, right? And then there is, first of all, the foreign bank account report that if in aggregate, each year stands on its own. On any day during that year, if the balance in total of all those offshore bank accounts exceeded $10,000 in the aggregate, then for that year, you're obliged to file the foreign bank account report, to report that. Now, I represent a lot of clients who, for whatever reason, were delinquent. Now here, unlike income tax, which has a 3-year statute of limitations, for the failure to file a foreign bank account report, they could go back 6 years. And the penalties are severe. It's $10,000 per account per year. So that really adds up. Now, as I mentioned before, I represent a lot of clients in IRS amnesty programs. The various different programs, depending on the facts and circumstances, trying to establish reasonable cause, trying to establish other extenuating circumstances within law to lift those penalties or to get a mitigation of those penalties, a non-willful statement. But you really want to avoid that. You really want to know in advance that if in 6 months I'm going to get the green card, or if I'm not careful, I could violate the substantial presence test. These are the implications once you get U.S. tax residency, and I have to have a good accountant, et cetera, to do the tax reporting. And there's also FATCA reporting, separate and apart from the foreign bank account report, to report your offshore financial assets if you exceed a threshold. If you fail to file that for a year, another $10,000 in penalty. Well, this starts to add up. If you have interests in foreign corporate entities, which are classified for U.S. tax purposes, either as a partnership, if you have a joint venture, or if you have different type of corporate interests, depending on the stock ownership, whether it's active, they're all different types of reporting forms once you're a U.S. tax resident with respect to your interest in the foreign corporation. Now, if, and this happens a lot, you were delinquent and you didn't file those forms with the schedules and everything like that, then you're going to be hit with, again, $10,000, in penalties. With the gift tax, also, if you don't file that gift tax reporting form, or if you're a U.S. beneficiary of a foreign trust and you get distributions, or there was a death of the creator of the trust, or you're making contributions, to that foreign trust, and you're U.S. beneficiary, and you fail to file that form, you're also going to be hit with penalties. So it's really important in advance, to have a roadmap of all the implications tax-wise once you become, once that change takes place from non-resident to resident tax status.
Thank you, Gary. Another question that I think is most relevant for you. Does a US tax department consider appreciation or cost inflation while calculating capital gain on sale of property?
Yes, that's a very good question. The measure of taxable gain on the sale of property is the current fair market value selling price of the property compared to the acquisition cost and any other subsequent contributions, capital contributions. And the difference between the two, if there was appreciation, would be a capital gain, and that's subject to capital gains tax on the sale once you're a U.S. tax resident. Now, what a lot of people don't realize is that when they come over to the United States with their families, they're under the impression that there's a mark-to-market rule, that there's an automatic adjustment upwards to fair market value of the original cost for the acquisition of that investment or that home, right? So that would be favorable if there was such a rule, because then the excess of current fair market value of cost basis stepped up to fair market value on the date of entry into the United States. You might not have any taxable gain, but unfortunately there isn't any such rule. So a lot of people don't know that, and without the planning, and they come in and they become tax residency, and lo and behold, they're hit with federal and state capital gains tax on the entire gain, even the gain that accrued prior to becoming a U.S. tax resident. So that's an important point for them to realize.
Gary, just a question on that. Again, on the non-immigrant thing. If I come in as a non-immigrant, and then let's say 2 years later, I get a green card, can I somehow be sort of hit by that from the date that I become a non-immigrant, or do I not have to worry about that? Is it only really when I get the green card that I have to start worrying about these things?
If you're a non-resident and this sale, took place while you're a non-resident, for income tax purposes, even if you're present in the U.S., but you're not under the substantial presence test here. So from all different predicates, you are definitely a non-resident. Then
No, that's not what I said. I said, I come to America, so I meet the physical presence test. See, I'm living 100% every day of the year in America, or even, let's say 7 months of the year in America, but I'm on an L1 visa as a non-immigrant, right? So I don't worry about the fact I've got a house in India that's rented out and I'm going to sell it. Now, 2 years later, I get a green card. Can I wait to do that planning so it's just done before I get the green card, or should I be doing the planning before I establish residency as a non-resident? Does that make sense?
Yes, you definitely have to do the planning prior to you establish residency based on presence.
Okay.
Don't wait till
so before, just to put it in clean English, before I step foot in the United States on an L visa or an E2 or a student visa even, I need to perhaps resell the property in India, or some other tax strategy that Abhijit would need to be involved with too, because there'll be an India side implication, to make sure that I'm not going to get hit with a horrible capital gain unnecessarily. Is that right?
No, that is correct. But I just want to say, subject to the caveat, that under some of these student visas, like an F1, there are treaty rules and the domestic tax rules that days of presence under that visa up to a 5-year period don't count. You don't count them as days of residence, of days of presence. So you might still be considered a non-resident for income tax purposes under this F1 visa, notwithstanding that you've been present full-time here up to a certain point in time. But outside of that, I agree that the planning has to be done before you set foot in the United States, or before, the year that you would become a U.S. tax resident.
Gary, maybe we can do like a sheet for clients, Gary and Sanjay and Abhijit, that's just sort of headliners, right? Things to be aware of when coming to America. And really not to give any detail, but just to sort of give some headliners. And then if people have questions, they can follow up. What do you think, Sanjay?
Absolutely. So following this event, we are going to be sending out personalized emails to everybody who's taken the time to attend this webinar. Obviously, all of our clients are in very different circumstances through the CV5 processing timeline and come from different countries, so there's different implications. So we can certainly put a crib sheet together to help open up a conversation, but we'd also invite them all to have some personal consultations with us as sort of the DNA team in terms of where they are currently with applications, but also with Gary and any other relevant tax specialists pertaining to the countries that they come from. Mark, I have a question for you. It's in relation to, obviously, a lot of our clients are at different stages of the EB5 process. Are there any sort of timelines, waiting times, things to consider for clients that are coming up to the I-829 approval stage in the EB5 program?
Yeah, so with I-829, I think as everybody knows, let's just recap. When you've had your conditional green card for 2 years, it expires. So the solution, so if you have not obtained if you've not had an I-829 approval before that time, then you certainly have, you'd have to be filing for the I-829 before the conditional green card expires at the sort of 2 years. So obviously, right, you can't be left out of the loop. So you can't wait 2 years and then apply because you might not be covered. So what the law allows is you to apply for the I-829 2 years, excuse me, I'm saying the wrong thing, 90 days before the expiration of the 2-year period. So 90 days before your 2-year conditional green card expires, you'll be filing for an I-829. The I-829 processing times have varied pretty wildly. So if you look at the USCIS website, where they give you average processing times in a range, you'll see that. You look under the IPO office, you'll see I-829 times, and it's like 1 to 2 years. So here's the problem, right? You apply, you get an extension on your conditional green card for a year while they're processing the I-829, but then it takes more than a year. They've done different things about that at different times, but basically there's a mechanism for automatic extension, so you don't get caught by that. So that's generally how that works. Sanjay, was there a sort of follow-up, a more detailed question on this?
I think it was more trying to get an understanding if there's any potential delays in the I-829 processing stage right now.
I mean, some of the I-829 times are taking a very long time, but you know, remember that your green card is getting extended. So you're here on conditional, you're here with sort of green card status. It's just sort of a question of time for waiting. If an I-829 got really stuck, then we could sort of push it. But also remember your time for, you know, a lot of people care because once you've had your green card for 5 years, you can apply for US passport. And people start to get worried, well, I've only got a conditional green card. That's irrelevant. So all the number of years that you're taking add up. And it's starting to be that some cases get very delayed for one reason or another. And once the 5-year period as a conditional resident is up, if they haven't approved your I-829, you can file for US citizenship. And it causes them a little bit of an internal problem, but that's their problem, not our client's problem. So, you know, that 5-year period on US citizenship starts ticking once you get your conditional green card, and nothing stops it. Yes, there can be I-829 delays, but as long as we make sure that they continue to extend your initial green card, there really shouldn't be any problems. There's really, I don't think there's anything to worry about in that context. You know, people worry, well, I need to get through the process. I want to get the US citizenship. Approval or not of the I-829 under the law as it stands doesn't delay your path to US citizenship. It could be, I think we have one client now where this has happened. It could be that you never get an I-829. You go straight from a conditional green card to US passport. That's not what they want to happen. And they'll claim that they can't do that, but they can do that. And that's what the law says. And if they don't do that after the applicable amount of time, then, you know, all I said about going to court and wasting money sort of doesn't apply in this context. You know, I would be very happy to go in front of a judge and the judge is going to tell them to naturalize you as a US citizen. So does that answer the question, Sanjay?
Yeah, I think it does. And we can take this up separately with the individual sort of client to look at where he or she is sort of right now in the process. I'll just look at a couple of other questions we've had. We may have covered some of these in slight variations. If we have, please pardon me. This is for yourself, Gary. Is the cost basis of assets of an EB5 investor immigrating to the US automatically adjusted, i.e. stepped up or stepped down upon his or her becoming a US resident?
I think
No,
we answered
that's
that.
what I just mentioned. There isn't such a rule. There isn't a mark-to-market rule. You know, so that means that if you don't do the advanced planning and there was a sale, a subsequent sale when you're a tax resident, there'd be a huge capital gains tax. Of course, it would include all the gain that accrued pre-residency as well.
Okay. Thank you, Gary. Someone, I know we mentioned writ of mandamus earlier, Mark, and I know we are planning on having a separate webinar in the near future to to sort of talk about that in a bit more detail. Someone's asking what the timeline for that process could look like.
Well, I mean, we can put together a writ of mandamus petition very quickly. You know, probably Scott, who's muted and not on video, is responsible for sort of making sure that these processes move forward at our firm, with a different lawyer who specializes in this type of litigation that we have on team. So, you know, that case can be put together very quickly if what I call the precursor steps, which I mentioned, are: 1, documenting correspondence with IPO about the case; 2, proof that we've approached a senator; 3, proof that we've approached the US Ombudsman Office, so long as it still exists right now. As long as we've got those proofs together, then that petition could be filed in days, really. Now, in terms of, this is where it sort of gets a bit nebulous. Law firms who do this all the time will claim, well, we get a response within 6 months. I would say in a lot of those cases, they would have had a response from USCIS anyway within 6 months right now. But, you know, I think what I see just talking to different people is that sort of some kind of response within 6 months. Now, here's another problem that comes up. Someone files a writ of mandamus. USCIS definitely want to respond to that. Sometimes their response is, okay, we don't want to go to court, so we'll adjudicate it immediately. And they just throw an RFE at the file, because then the law case no longer exists, because the case has been adjudicated. It's been adjudicated with an RFE. So we know that where USCIS are getting some of these lawsuits, their response is simply to throw an RFE at the file, which makes the lawsuit go away. Other times, you know, I think, so you know, if your case is, it's really case by case. If your case is really stuck and there's really no explanation for it, or, you know, cases have gotten lost in the system, that's definitely true. Fortunately, not any of our cases, and I'm not going to claim it's because we're especially clever, because I don't have any control of what USCIS and the National Visa Center do. But some of the other law firms' cases have definitely got lost. That's not their fault. I'm not saying we're better than them. That's not true. It's just luck that none of our clients' cases have got lost. But if they get lost, we probably definitely want to file a lawsuit, because a judge is not going to have any tolerance for that with USCIS. And, you know, bluntly, the client probably benefits from that if that happens. But I mean, that's pretty much the process. It can be filed very rapidly. You'll get a response from USCIS quite quickly, but be prepared for the fact it might be an RFE.
Thank you, Mark. I think we have some specific questions which relate to individual consulates, so I think we'll take them offline in terms of immigration visa interviews rather than hold them open. I think looking at most of the questions that we've come through, we've already covered in detail. Are there any sort of final points, unless I miss anything, that perhaps the three of you would like to add in terms of perhaps summarizing, or are there any other key areas that we're yet to explore?
I think, Sanjay, we covered pretty much what we need to do. The only thing is we should encourage all our participants to reach out to us to initiate conversations at the earliest. Each family and each situation will have a different solution for us to work upon. And as we highlighted multiple times, time is of essence. They should give us sufficient time to come up with a workable solution. And anywhere between 6 to 18 months would be reasonable.
I just wanted to add to what Abhijit said, that it's not one size fits all. A particular of a tax planning strategy is always militated by the unique facts and circumstances, you know, of that particular client. And the other thing is, Abhijit and I spoke about this, the importance of working together as a team and coordinating. So you have a full integration from an Indian tax, a US tax, business tax, and also from an immigration law standpoint.
Sure. Mark, any final comments?
I mean, just, you know, I would say, you know, a lot of clients have questions, and, you know, I'm always here. I'm surprised, you know, bluntly, that some of the clients I don't hear from, more often. Obviously, we need to reach out to our clients and take responsibility for that. But you know, if you have any questions, I'm always available on WhatsApp, especially. You know, if I'm on a plane or something, I can't respond immediately. And if it's, for example, a detailed tax question, if you ask me, then you might have Gary returning the call because I'm not capable of answering the question. But you know, if you have questions, you know, please reach out. That's I think what I would say.
Sure. Well, I'd just like to end by thanking all of our attendees today. Thank you for, as I said, taking the time out to schedule what's been a very productive sort of almost 2-hour session on sort of tax and EB5. Sort of our follow-up, what I would like to do following this webinar is to send you all an email personally in terms of providing you with some of the content that we've shared today, as well as contact details for Gary and Abhijit. We'd welcome the opportunity of having further dialogue with you in terms of, say, initial consultations on a private one-to-one basis to help you sort of talk through a lot of the sort of nuances of your circumstances in more detail. And I think that would be a great way to move this forward. We're also going to be staging a series of further webinars over the next 1 to 2 weeks, and some of those will include some of the topics that we've covered here. So, you know, we can certainly engage with Can-Am to look at some of the questions that have been asked specifically of them. We can look at the writ of mandamus, a separate topic. We're also looking at putting something together to help people who would like to set up businesses and operate businesses in the US, and sort of how to go about doing that as a separate sort of dynamic. So, you know, please sort of look out for our communication over the next week or two, and we would love to engage with you further. So thank you all for your time, and thank you for our panelists, Abhijit in Mumbai, Gary, thank you in New York, and of course, Mark.